Thank you for joining me. I'm Alex, and I would like to do an analysis of Dollar Tree. And what's funny is that I'm doing a lot of companies that are dividend aristocrats, which means they have raised their dividends 25 years in a row. And Dollar Tree led to the demise of one of them because they bought Family Dollar. So out of that arising certain few things that I disagree with general accounting principles, and that leads to an underperformance of this stock in particular at this time. But we're almost done with that. So they do retail, obviously. And current price is $93, which gives them a market cap of $22 billion. Interestingly enough, they don't pay a dividend right now, and probably won't for a while, although I would assume that if things kind of come together in a certain way, they will start paying a dividend, but I wouldn't count on that at this time. So if you're a dividend investor, kind of stay away from that unless they make an announcement that says that they might pay a dividend. Revenue $22.8 billion, earnings negative $1.6 billion, which is down 200%. And again, that has to do with the purchase of the Family Dollar. I'll get to that. Which gives them a PE of negative 14. Total assets $13.5 billion, total liability $7.8 billion, which gives them total stockholders' equity of $5.6 billion. Which is down 20%. And now we get to what caused all that and why it doesn't really matter. So they had a certain amount of goodwill from the purchase of Family Dollar, and that means that they paid too much in technical terms to purchase that company, which means that on the balance sheet it enters as goodwill because obviously it has to go somewhere. Now, they wrote down the goodwill for $2 billion or something like that, which means that they made a loss of $2 billion. But that doesn't mean that they lost any money anywhere. The money was lost when they purchased the Family Dollar. It's just that now it enters the balance sheet as a negative thing. So they're actually profitable right now, and the balance sheet is getting better quarterly. It's just that they have a loss from the last quarter of the last fiscal year that we're still kind of dealing with right now. Their year ends January 31st, which is kind of a good idea, I think. Also what Walmart does, because all the holidays are actually in the last quarter and also in the last fiscal year, or in the end of the fiscal year, which means that the fiscal year looks a lot better than if you compare it the first three quarters, right? So to kind of sum up the whole company, obviously dollar stores and discounters in general are doing fairly well right now. If you get out the loss from the goodwill, the company is actually profitable. I don't think it's profitable enough at this point to really recommend buying it. So they would have to get earnings of, kind of the same that they were before writing off the goodwill to be in a reasonable position. But even then, the PE would be around 13, 14, 15-ish, depending on where exactly they land. And they don't pay a dividend, and so I'm not sure I'm interested right now. I'm not sure that revenue growth of 3% is really worth that PE of, around 14-ish. So obviously, a dividend investor would be out at this point. A growth investor would be out at this point. For a value investor, I think things don't actually look that bad right now. So the PE, once it gets back to normal, doesn't look bad. The balance sheet looks amazing. And revenue is growing, so obviously that's a good thing. It's not growing that much, but If you're holding the stock for a long time, especially with a PE of under 20 and significantly under 20, I think that you kind of rely on steady growth of, 3% is pretty decent. So they're beating inflation with their revenue growth, which is pretty good at this point. So I think that for a value investor, if you're looking into these kind of companies, I think it would actually be a decent pick, because everything I just mentioned, and the segment tends to do very well even in a recession. So I would say it's a reasonably safe stock. Obviously, they don't tend to get disrupted that much by companies like Amazon, because to ship a dollar item, they would have to spend about, I would say, $2.50, $3 at the very least. So, Amazon can't really compete with a company like Dollar Tree unless they have a physical presence in a lot of cities. So I don't think there's too many risk factors here either. So if you're a value investor and you're looking into these kind of stocks, I think it's a decent pick. For everyone else, I don't think so. So that's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.